So I had a recent conversation actually with a family member who's starting to trade, and we're talking about pullbacks and keeps on getting stopped out on a complex correction. So I thought I would put together this video kind of centered around the conversation that we had. And, looking for pullbacks on a chart, it's totally viable. It's a great approach when you're trading. You find a strong impulse move in the instrument. You wait for a corrective decline for an uptrend, corrective decline. And the third thing is you buy when strength is returning to the instrument. But the challenge comes, as he figured out, is when a simple pullback, which is essentially one leg down, turns into a complex pullback, which can be multiple legs. So why is this a challenge? Well, if you go long near the bottom of the simple pullback and it turns into a complex pullback, you're going to take a loss in the trade. So the question is there a way to find a probability of one pullback type happening over another? And the answer is yes. And is this going to prevent a losing trade? No. But as a trader, we think in probabilities. We don't think in certainties. That's the main reason why your protective stop is the most vital order that you can place. So there's essentially two ways to determine the type of pullback that could be happening. These two ways are: one, rule of alternation, and two is an overextended price. These are simple approaches. They work, and I use both of these in my own trading, and other traders that I know do the exact same thing. So we're going to talk about rule of alternation. All that is essentially the repeated occurrence of two things in sequence. So if your last pullback is a simple correction, the next one has higher odds of being a complex correction. And after the complex correction, you'd probably see a simple correction. Now keep in mind, each time frame is going to have a slightly different look. Okay, a simple correction on a daily chart may actually be a complex correction on the 4-hour, the hourly, or any other day trading time frame. Chart patterns, they're not always as clean cut as the last one you see on this chart. This looks great. The complex pullback is more representative of what the average chart pattern is going to look like. So don't expect to find perfect looking patterns. And this is one reason I always mention concepts. We're trading concepts, not the pattern itself. And after you see a complex correction, be aware that the next pullback might only be one leg. Look for strength on the reversal, whatever your trade entry is going to be. Second one is overextended price. And this is often referred to as oversold or overbought. And there's different ways to determine oversold, overbought. You can use RSI, MACD, Keltner channels, Bollinger Bands. But you can also see an overextended market just by looking at large price bars after you see a series of smaller ones. Okay, you're going to see a change in character, in price. That shows something has changed in the buying or the selling pressure, and this is very useful information. I want you to notice the difference between the first set of candlesticks in the middle and the last set. Now, the average true range reading went from $1.02 in the middle of the trend, this is a daily chart, to $1.37 at the peak. Now, this pullback is clearly not just a simple pullback like we see in the middle of the chart. If we put on Bollinger Bands, it shows prices above the upper band and a widening of the bands. That's strength. It's also the end of 5 days of sustained buying pressure. The momentum thrust down was 3.5% in 1 day in the red candle. And that leads to a complex correction that's currently underway when this video is being made. So combining all that together, that points to a complex correction. Now, a complex correction, generally in the textbook, they talk about two corrective swings. It's a very simplistic way to look at it. We can have multiple legs in a correction. We have a daily chart here. The price continues to pull back all the way down and actually fills up a gap. There are multiple lows that you may have looked to enter at, depending on whatever you use for an entry trigger. It took 4 reversals to finally follow through. This price eventually goes on to make new highs in this chart. So the question now is going to be, how many reversals will you attempt to trade? So if you are using the rule of thumb of 2% risk per trade, and you didn't adjust your trade on any of the price that went in your favor, you're already down 6% before you're being rewarded with a move. So can we look for something in price that shows a higher probability of a positive reversal in your direction? Yeah. Loss of momentum. So keep in mind, again, there's always going to be exceptions, okay? We're just looking for the probability of one thing happening over another. In this case here, the reversal that actually worked showed a different character than the other lows that failed. Instead of quickly reversing off of the lows like the other ones did, price actually pauses and shows that, at least in the short term, there's a lack of further downside. It's in this little range that you would look to enter. And you can also look at this video on trading breakouts, and it's one way of entering long when this occurs in whatever instrument that you're trading. And look, this is not perfect. Okay, it's not a guarantee, but at least you're using structure and market rhythm instead of just pushing buttons and jumping into a trade. And if you do happen to enter thinking that you have a simple pullback and it rolls into a complex correction, well, where is it probably going to fail? Well, here. Now, this example is not the best because that red circle that's highlighting the upper long shadow there, that actually indicates some type of exhaustion of price to the upside. And yes, that is another clue of a complex pullback could be in the cards. However, if you went long on that small red candle there, price moved to the upside on low momentum, and where did it fail? In the area of that pivot high. And once you see price reject that zone, making it now resistance, you would be wise to start to manage your trade or just get out. Remember, you can always re-enter a trade. The key to look for is the dying of momentum after that reversal, because we expect buyers to enter, right, to help propel price if there is any hope for a break of the highs and a continuing of the trend. Now, this is not meant to be a full course on trading pullbacks, right? There's a video called Profit from Trading Pullbacks that you can look at. But what we did cover is an important piece when you're looking for continuation trades, because we want to put ourselves in the best position to profit, and any edge is a good edge. And to do that, we got to have some idea of the higher probability of something happening over another thing. So if you're looking for the perfect chart patterns, they're often messy. Okay, we got to look at the overall structure of it, as well as the presence of or the lack of momentum, because that's what's important. When we talk about perfection, you're going to find it in every single textbook that shows you things working out no problem. But that's not trading. That's not how it works. Thanks for watching. Hit like, hit subscribe. Any questions, pop them here. Talk to you again.